And welcome, I'm Toby Gennaro. I'll be your presenter for today. For today is Becoming a Candlestick Connoisseur. Gotta love that. So I'm gonna be talking through the technical analysis that traders will use to identify trends, their entry, their exit points related to their trading strategy, and then how to use that technical analysis in your trade planning and your risk management. Now, for those of you that are on the live webinar today, if you have questions during the session, you can just type those into the question box on your screen. I may be asking you some questions as well, so we'll try to keep this interactive, okay? All right, first, I just want to put up the risk warning and disclaimer. We've got to do this as part of the business. I'll leave this up for about 60 seconds or so as a requirement. Please have a quick read through this. What this is saying in brief is that we provide education only, which means we do not give any financial advice. And as most of you know, trading the markets can be risky. It's not suitable for everyone, and you should seek independent professional advice. All right, everybody good with that? All right, one more disclaimer here from Trade with Precision. Just have a quick read through this one, and that'll wrap up the risk warning and disclaimers. And just so you guys know, Forex has been asking us to extend the length of time that we have these up on the screen, so I kind of got to do a little bit more. I used to do them for 30 seconds. I got to do them for 60 seconds now, so hope you guys don't mind. I know you've probably seen these many times, but all right, very good. Is everybody good to go with that? Okay, so moving right along. The agenda for today, we're going to jump right into the live platform like we normally do on these sessions. We're going to talk about why candlesticks are so important to us as traders, right? That's an important thing to know. I'll demonstrate how to use candlestick strategies to trade Forex across all the time frames that we'll look at today on the charts. And then I'll show you how to combine multiple technical factors with candlesticks to further enhance your trade thesis. And then we'll take a look at the candlestick clues that provide us sort of a heads up about trend reversals and how to think about that. And we'll do this all on the live charts as we normally do. All right, so let's get things kicked off right here. I want to jump straight into the platform, show you guys how to get the platform set up properly for trading, and then kind of walk you through some of the items I just talked about. So give me a minute here just to get everything set up so you guys can see what I'm seeing. And we'll drag this right over there. We'll get that blown up for you. Okay. So you should be able to see the two charts I have up in the Forex platform. I want to show you a couple of things right out of the gate. If you ever take the advanced trading courses that we teach, the advanced strategy courses, we have a certain setup to our charts. We use basically 6 indicators, and that's kind of what I'll be running through on today's session when we look through live charts. We have 4 moving averages. We have the 200 in green, 50 in red, the 20 in blue, and the 10 in black. So those are the 4 moving averages that we use. You can use either the simple or the exponential, doesn't make much difference. And then we use 2 oscillators, the RSI and the MACD. The difference here is we're not trading the overbought and the oversold zones of the RSI. We're not trading the line crosses of the MACD. If you use these charts or these oscillators that way, they will typically only give you valid signals when the market is moving sideways. And that means it's a ranging chart, there's a high and a low, and usually these oscillators do a pretty good job of calling the high and the low. But there are a lot of problems with trading that type of a chart because it's not trending. It's hard to identify your risk, various things like that. And so the way we use them is in terms of price indicator convergence or price indicator divergence. So when we're getting a downtrending chart, we want to make sure that the indicators are trending lower as well along with price. And you can just highlight the price and line it up vertically and see where the lower low is. And that's how that works. So these are trending to the low side, which means the trend is still strong based on that convergence. Same thing on the MACD. We can just line those up and we can see how everything lines up. Now, when you start getting lower lows in price and you start getting higher lows on the indicators, then you have price indicator divergence. So if you've got a downtrend on the chart and an uptrend on the oscillators, that's a very bullish sign. It means the downtrend is weakening, and you should probably move to the sidelines. Usually about 2 to 3 divergence bumps, meaning 2 to 3 lower lows in price and then 2 to 3 higher lows on the indicator across 2 time frames. Usually that's about the end of the run, and you're probably going to see a technical bounce from there. Probably want to move to the sidelines. So that's kind of how we look at not only the indicators to identify when the trend is weakening, but we can also utilize the candlesticks, which is our topic for today, in understanding where some of those turning points are. And that's what we want to take a look at today, is the candlesticks, and then we'll throw in there some of our strategies that we utilize, which are based on candlestick entries and candlestick formations, and kind of show you why those are so important to us. And if you want to learn any more, you can go to the website forex.com and look for some of those trading strategies, and we'll show you how these work in detail. All right, so let's take a look. I'm on right here on the Aussie dollar for really no apparent reason. There's no trend. Everything is kind of sideways here on the weekly. Don't think there's anything better on the monthly. Let's take a look. Actually, the monthly's got a decent trend there. Nice channel there. We have the 50, the 20, and the 10. Even got the 200 in on there. You'll notice whenever you start getting lower highs and lower lows, and we don't actually have a lower low yet. We're in a little bit of a consolidation there, but from here we have a lower high, lower high, lower high, lower high, and we have a lower low and a lower low. So this right here may be setting up for another lower low. That's the way it looks, but that'll remain to be seen. But right now we do have a trend to the downside. It's not showing up very well because of this consolidation right here on the weekly chart. It's not showing up really that way. But in essence, we have a lower high, lower high, lower high. We just don't have necessarily all the moving averages in alignment and open to the downside, which is what we want. And we don't have price action in a nice formation like we did on the monthly, where everything is flowing straight down. Candles are all of a similar size, right down at a 45-degree angle, price taking 2 steps lower, rebounding 1 step, taking another 2 steps lower, rebounding 1 step. That's typically the price action that creates a nice 45-degree angle on the chart. So that's the kind of price structure of the candlesticks that we want to see, and that's why it's so important. So by the size of the candles right here, I can see that a lot of candlesticks are larger. Some of them have very large tails. And the problem with trading on large candles is that you have to put your entry, at the top of the candle and your stop below the low of the candle or below the swing low, which all of a sudden, to get the trade to break even, price has to run like all the way up to here in order to get the trade to break even. And that's not always, that's not a great thing, because it just increases your risk on the trade. And what we want to do is exactly the opposite. We want to decrease our risk on the trade and increase the opportunity for profit. So in looking at some of these charts, we've got the daily chart is in a bit of a downtrend. We've got the monthly chart in a downtrend. So I think primarily overall, it's a downtrending chart. Even though we're sideways on the weekly, chances are pretty good that this is going to follow a breakdown to the downside in correspondence to the monthly chart. So here you can see we've got a number of daily candles to the downside, which means if we go lower, more than likely we're going to see some charts trending to the downside with the formation in the candlesticks and the indicators that we're looking for. So right here, the 4-hour chart is where everything starts to get into alignment, and we only really need the 50, the 20, and the 10 in alignment, fanning out to the downside with the correct price action structure. And that's really going to be enough for the strategies to work. We don't always need the 200 period in on the action. If we do have it, that just tells me that there's just a longer term trend that we're trading, and we've got all 4 moving averages in alignment. But it's not absolutely critical. The strategies will still work without the 200. And then let's take a look at the 2-hour. And so as you can see on this one, we've got lower high, lower high, lower low, lower low, lower high, lower low. And it looks like we're putting in another lower high right there. We're just not quite in the middle of the 10-20 period zone. Whenever we get a rally back up into that equilibrium zone, Usually that's when the sell-off starts and you get a nice bearish candle in the zone, kind of like that one right there. And so these really small candles that are either outright bearish rejection candles, or they just might be very small doji candles, like indecisive candles. And I'll show you what those look like as soon as we run into one. But when those show up in the middle of the 10-20 period zone in a downtrend formation like this, that is usually the next signal of a sell-off to another lower low, at a very least a retest of the most recent low. And so to find that, we just need to go down through the time frames and continue to take a look. Not a great looking trend, but it's not horrible. And as you can see, we've got the moving averages in alignment, 50, 20, 10, lower highs, lower lows, everything there. That right there is a indecisive candle, where it's neither a rejection candle or anything else. The open and the close is right around the center. This one is actually a rejection candle, where it looks like an upside down hammer, and you got that long tail right there. That's called a doji rejection candle. So this is actually a doji rejection candle too, just in the opposite direction. We're not interested in those because the trend is down, and we want to look for candles that are bearish. And we've got a bearish candle there. We've decisive candle there, which means that's bearish because it's in the sell zone. And then we're actually getting another bearish candle setting up. But for the most part, we already have a key candlestick pattern right there. And usually when you get multiple candles in the zone, small candles consolidating together, usually they create kind of a flat level right there that you can see. All of these three, none of them are breaking through that level just yet. And when this candle breaks through that level, that's when you're going to see all the sellers pile in, because there are a lot of sell orders that are open that are sitting right there at that level. So our entry goes right there, probably just a couple pips below the low of those four candles. Stop goes just above the high, a couple of pips above the high of the highest level of those four candles, which should then be the next lower low in a whole series of lower lows that we've had in this downtrend. And so what that gives us is a very small candle structure, and it gives us a very tight risk reward composition. And we can basically get this trade to break even, actually right about, kind of eyeballing this, probably right about there. We dump half of our position, get the trade to break even, leave our stop right there where it is, and then look potentially for another 2-to-1 reward there, and possibly a 3-to-1 reward there, with the remaining half of our position just dumping a quarter of that position at each of those next two targets. So that's one way to utilize kind of a standard deviation in a way of selecting your targets. The break even is always going to be the standard. You always want to find a way to get the trade to break even as quickly as possible. Usually doing it on a 1-to-1 reward to risk is usually the most probable and the best practice for doing that, and that's why we teach that. And so getting that trade to break even, sometimes it won't hit target number 2 and target number 3. Sometimes it'll reverse and you might get stopped out. That's perfectly okay. It's just going to be a break-even trade. There's no profit, no loss, but we're identifying the correct candle structure in order to do that in our overall trade strategy, which in the end, it lowers our risk and it gives us more of an opportunity to succeed over time. So here we have lower lows on price. We don't have a higher low, probably have equal lows on the indicators. That's perfectly fine. Here we have a lower low from this lower low, and another lower low. So everything here is pretty much trending to the downside along with the lower lows in the price action. So the trend is still strong. More than likely, there's a higher probability that this candle structure will break down and at least retest the low here at 65.045, if not put in a downright lower low. And that's kind of how the strategy works. Now, the strategies don't work 100% of the time. It's about a 70 to 80% probability as most strategies, but in the markets, a 70 to 80% advantage is really critical, because even if you're a horrible trader at just 50-50, you still have the opportunity to be successful in the markets. Okay. So just a little thing there. Let me take a look at some other lower time frames. So, when you go lower to the 1 hour, you start to get a cross up of the moving averages. Can't use the 1 hour chart So that means we're automatically relegated to the 2-hour and the 4-hour, and I'll show you what that looks like side by side. We're basically looking for two time frames side by side, the 4-hour and the 2-hour, or the 2-hour and the 1-hour. Usually the trigger chart, the way that's identified is that the small candlestick structure is right in the middle of the 10-20 period moving averages. And you have the 50, the 20, and the 10 all in order, in numerical order, and aligning and fanning out in the direction of the price action trend. And that's exactly what we have here. And so we checked the 1-hour. The 1-hour was crossed over on the moving averages. Can't use that. We checked the 4-hour, and the 4-hour, lower highs, lower lows, 50, 20, and the 10 all lined up to the downside. Everything looks good, and we're ready to check out that trade. So that's just one example of how to do that. Would ask that you don't take this trade with real money until you've actually taken the course and you understand the entirety of the trade setup. We take about 4 hours to teach this particular strategy. So just because I'm showing you a couple of highlights here doesn't mean that you're all booked and ready to go and you can start going gangbusters. You want to make sure that you understand the risk, how to calculate your risk, how to calculate your position size. All those different things are all part of the strategy. So it's not only about taking profit, but it's about the entry, it's about the stop loss, it's about how to set profit targets in a number of different ways. It's how to protect yourself by trading on small candles. In other words, if we had a large candle in the center of the 10-20 period moving average zone, that would be much less attractive because it would put our stop all the way up here and our entry, all the way down here. And then all of a sudden, to get to break even, all of a sudden I got to break the low and get to break even way down here with my stop way up here. So all of a sudden we've just added a lot of risk to a trade that we didn't really need to. All we need to do is just understand the strategy and why the candles are important. And we always want to be trading on small candles. Okay, so this is the same for the downward trend. If this was an uptrend, it'd work exactly the same way, except the moving averages would just be in opposite order. You'd have the 50, the 20, and then the 10 on top, trending up with the with the price action structure. Okay, so that's just one example of how we would use what we call the trend flow trade strategy. I don't know, there's another one that we're teaching that is, actually I can probably fit it in on this chart. Let me take a look real quick. The Fibonacci cluster strategy is another one we're teaching, where you can draw a Fibonacci going in the direction of the trend from the most recent lower high to the most recent lower low right there. And usually what happens is when you do that in a trending structure, the rally is not only going to rally back up into the equilibrium zone, it's also going to rally right in between that sweet spot, the 61.8% and the 50% Fibonacci retracement level. And whenever price action gets right in and around there, that's usually where you're going to see sellers jumping on board to continue to sell off this downtrend. And lo and behold, we not only have candles in between the 10 and 20 period moving average, but we also have the 50 and the 60% Fibonacci sweet spot right in the middle of that 10-20 period moving average, and the price action is rejecting almost the center of that sweet spot. And so that's another thing that gives us a lot of confidence in having that setup. We can also utilize pivots. It's hard to see. You got to use these on slightly lower time frames, so you get so things are spread out a little better. But let me see if I can identify this. What we want to do is we want to find, these are the this is the center point of the pivot. This is resistance 1, 2, and 3, and support 1, 2, and 3. Doesn't matter how these are calculated. It's an indicator. Add them to your charts, and they just show up at the start of every trading period. And what we're looking for is we're looking for an overlap of one of these, either the pivot point here or the S1 that overlaps into that 61 and 50% level right there. But we're not getting either one. They're at complete opposite ends. And so there really isn't anything additional on in terms of what we're looking at that we can grab a hold of. What we'd like to see is we'd like to see some previous price action, like this type of price action right there, where price rallies back up into a resistance level. You get a pivot that aligns right there. You get a 50 and a 62% zone right around that level. And all of a sudden, all these things start to align, and it creates what's called a price action barrier, or a cluster trade, as we call it. And this is another strategy that we'll teach you in the advanced courses. And so very high probability when price bounces or rallies back up into that zone, up against that level, we have 3 or 4 things working for us or more that really help to create a favorable lower risk price action structure that we can trade from. So that was just one example. Go ahead and look through some more charts and see if we can find some more of those. Let's take a look at the, actually, I've got a question here. Let me take a look at that. Dan's asking if one is in the Eastern time zone with Forex being a 24-hour market, what are the best times to enter a trade? Great question, Dan. I love answering that one. A lot of things that people don't realize about trading is that there are better hours to trade, not only in Forex, but also in equities and a number of other markets. And the reason for that is because people are working. It revolves around a work day. So in the U.S., just figure it 8 to 5, whether it's West Coast, Central Time, East Coast. You can figure out the time zone calculation. But what you want to do is you want to basically trade market hours or business hours, in the time zone in the continent that you're on. So for the U.S., East Coast to West Coast, it would basically be the 8 to 5 scenario. Once the business day ends in the U.S., then there's going to be a several-hour lag period until the Asian markets fire up, or people are getting up and going to work, the same type of 8 to 5 schedule, if you will, and then that starts the next trading period. And then when that ends in Asia Pac, then there's a few hours of a time lag until the Europeans start to wake up, getting showered up, going to work. It's just based on a work dynamic, believe it or not. And that's where people are doing their trading. There are professional traders doing that, pension fund traders, and everybody alike. People tend to work, 8 to 5, somewhere thereabouts, maybe even into the later evenings. But those are typically the best periods to trade. So even though it's a 24-hour market, there are periods in there where there's going to be low volume, low activity, and the charts are not going to look good, like some of these charts. They're going to look more fragmented. They're going to be flat. They're going to have some very odd candle structures to them. Those are the charts that you don't want to trade. Okay, but good question there, Dan. Let's see. Let's take a look at the euro yen. See what's going on there. Let's go back to I always like to start at the top, look at the weekly and the daily, and that gives me a good sense for what's going on, and kind of gives me a bearings on which way I want to be trading these markets. I always want to be trading in the direction of the higher time frame. And here you can see the weekly chart, really nice, all similar size looking candles. If I were to draw a line from the corner here to the corner there, that would be about a 45-degree angle. And that's pretty much exactly what the price action is doing. It's on a nice 45-degree trend. The 200, the 50, the 20, and the 10 are all in alignment. We just got a nice bullish candle in and around the buy zone. We just broke the high of that, and we're off to the races, to the point where this level right there is probably going to be a level of resistance at 164, and we're actually getting this level right here was one divergence bump. You can see it's a higher high from this high right here. We went another higher high and got some divergence there, went another higher high and got some divergence there. Those are really the two divergence bumps that we're looking at, and then you kind of got to rethink your strategy, and that's why you get a technical sell-off right after that. So these really are very accurate, and we had the same thing happen right here on the MACD. So when both of them are setting up that way, that's a very negative, bearish, connotation to this uptrend. And that's why you got this big sell-off right here. Didn't necessarily reverse the whole trend, but it did get a big sell-off. It actually broke the higher low, and then all of a sudden started to trend upwards again. Usually what that means is all of this divergence usually means that there's going to be a deeper pullback on the next higher time frame. And so just going to the monthly, you can see that that big pullback on the weekly chart was just a pullback into the buy zone on the monthly chart. And the monthly chart really reveals this beautiful trend structure, all similar size candles, the 200, the 50, the 20, the 10, all fanning out, open to the upside, pullbacks into the moving average zone on the monthly, setting up these candles. Now these candles on the monthly, these are pretty big, even though they're a reasonable size. They contain a month's worth of price action, which means more than likely what you want to do when these set up, when a nice bullish candle sets up on the monthly, usually you can go down to a lower time frame and find a nice trend very similar to this and trade that smaller time frame in the same direction as the higher time frame, and you'll find the same exact chart setups there. So that's why we're interested in this particular chart. It looks very good. Now we have a takeoff from that trade zone on the monthly chart, and that's why it starts trending up again all the way back up into this level. Now that level right there is more than likely it's not a key level yet, but being that we have so much divergence, it looks like it's going to diverge again on the retest of that level. And if there's any kind of a breakthrough, I'd be very questionable as to how far that breakthrough is going to continue. So we're already seeing the trend here on the price action, and we've got this kind of a trend on the MACD and the RSI. So that is divergence, and we're also getting, let's see, we're also getting divergence from this high to that higher high, and we've got divergence on the RSI and the MACD on the daily chart as well. So we're getting a lot of divergence across these two time frames, which is enough to keep me out of the trade. On top of this, I saw some news today fundamentally about the central bank in Japan actually looking to raise interest rates, which would more than likely curb some of the uptrend here and maybe cause more of a sideways motion. Right now, Japan has been in a state of stagflation, the exact opposite of the US, meaning the US is in inflation, so we lower interest rates to combat inflation. Deflation, I'm sorry, Japan is not in stagflation, they're in deflation. So deflation, you do the opposite, you raise interest rates, you lower interest rates to combat deflation. So both central banks are doing the same thing, and that's why you'll see even with the euro, they've been doing the same thing in a lot of the European countries to combat their inflationary pressures. That's why folks are buying euros and they're selling yen because of those central bank actions. That's why you're seeing this trend happen the way it is in terms of an uptrend. So once the yen, the Japanese start raising interest rates instead of continuing to lower them, then that's going to draw some more parity and balance between the euro yen. There's not going to be such a disparity between those two currencies to drive such a strong trend going forward. So I'd venture to say that I'd keep an eye out on that key level. It may set up a flat level to break higher. Just depends on what the the Japanese central bank does in terms of interest rates. And that's kind of the way things work from a fundamental perspective. But here we have some upward trends. If we were so inclined, we could move lower and start to look at how the trend structures form based on just those couple of candles that we saw. Now we've got the 50, the 20, and the 10 all in alignment, nice 45-degree angle, pullbacks into the moving average zone, those beautiful little small rejection candles right there, giving us a lot to think about. 2-hour chart, really nice as well. You can see the pullbacks are a little deeper. The moving averages are crossing over. That tells me that we're just probably a little too low on the time frame. And more than likely, the 4-hour chart is going to be any type of an entry chart if we're so inclined to trade this trend. And then the price action structure on the 8-hour chart, we don't have all the moving averages in alignment, but we do have higher low, higher high, higher low, higher high, higher low. higher high. So we definitely have a confirming uptrend on the 8-hour chart, even if the moving averages aren't completely aligned. Okay, so here, any price pullback into the 10-20 period moving average zone, we do have a confirmation chart in the price action on the 8-hour chart, and this is that would be a reasonable setup to trade going into, again, that key level on the weekly chart, which I'm not crazy about because it's so close right there, right around 164.3. There isn't a whole lot of room to run. And so that would be one of the reasons that would probably keep me out of that trade, is there's not a lot of room to run for a profit target until I run into, a level of support. Let's take a look at the monthly chart to see how far back that level goes. And you see there's been some key levels right around there, even up to 167, right around that level. And you can see a number of touches right around that 164 level, going all the way back to 2007, 2008, all the way to, almost to the end of 2008. So, so that there is a key level there at 164. You just got to scroll back to see it. We're actually putting in a second touch, the same as the weekly chart on the monthly. And so, overall, I mean, good looking price action, but we got divergence, we got some negatives that are going to keep us out of this trade more than likely. If I was interested in trading anything, it'd probably be the 4-hour and the 8-hour, and just looking for a smaller time frame and time window to trade in, knowing that you're not going to be holding it all the way up to a new high, and that would be the way that I would play that one. All right, don't see any other questions. Got a little bit more time left. Let's take a look at the euro dollar, see what that looks like. We've kind of exhausted the euro yen for a while. Now, the euro dollar hasn't been great. We did have a nice trend back here when we had, interest rate increases caused a nice downtrend in the dollar. And so, all of a sudden, once we had a change from interest rate decreases to interest rate, actually to interest rate increases to interest rate decreases right here, all of a sudden things went from, a half a point to a 3/4 point raise, and all of a sudden the Feds came out and said, hey, more than likely we're seeing a 1/4 point raise going into the year end of 2023, and that's when we had this this switch around, and that's when it caused, the U.S. dollar to decline, and folks then were buying euros, selling dollars, and that's what caused the increase. And then there was some talk about, sticking inflation and how are they going to handle that. More than likely, there won't be interest rate cuts until the end of 2024, and so we went into kind of a sideways period, which I've been talking about for quite a while. And that's why there's a lot of uncertainty in which way the economy is going to break, whether there's going to be stubborn inflation continuing, or whether that's going to resolve itself. And in the second half of this year, maybe the Feds can start to lower interest rates, which will then cause an uptrend. That'll cause the dollar to drop. People want to buy the euro, sell the dollar, and then it'll cause this trend to then start moving higher, creating higher highs and higher lows. We already have a move down here. We've already created a higher low right here, higher high right here. We're still consolidating. I don't see this taking off anytime soon. Moving averages aren't aligned. Everything on the daily chart is kind of sideways as well. So there isn't really a whole lot to look at here on the euro dollar. Don't like the charts at all. Even if I were to find something on a lower time frame, it's not all that convincing, because we just don't have a great trend like the trend that we had here. That's just a beautiful trend that I definitely want to be a part of. Let's take a look. Doesn't mean the day's over. We got a number of Forex pairs to look at. Here, the pound dollar usually moves very similar to the euro dollar. So we had that same nice trend occurring right there. And then again, we're sideways in and around here, have the higher low, the higher high, another higher high right there. And so, so it might be trending up. More than likely, I think we're going to be going sideways for the same reasons as the euro dollar. Had a lot of downward price action here, so there's probably not going to be anything on the lower time frames except short trades to the downside. And so more than likely, if anything, lower interest rates mean a lower dollar, and then that means folks are buying the pound, selling the dollar, which is going to point this higher, probably toward the back end of this year. Let me take some questions here from you guys. One question: where can I locate the classes on advanced strategies? This is very helpful. Glad to hear that. Yeah, go to the website, and then actually, you know what? I'll show you at the end. We'll go to the website and I'll show you where they are. They should be under the webinar section, and then you can look on there, and it'll identify the dates and the times for them. Another question: where can we get more education on these topics? I'll show you that at the end when we have a few minutes. We'll go to the forex.com website, and I'll show you where to get connected on those. All right, so let's continue on here. Let's take a look at the Kiwi dollar and take a look and see what's going on here. Big trend here on the weekly chart, very nice. Probably if we go to the monthly, it looks even better, I would imagine. So right here, we've got the 200, 50, 20, and the 10 all lined up, fanning out, lower highs, lower lows. Had a pretty big drop off here with a rebound back in to the sell zone, set up a nice big sell candle, sold off, put up a little bit of a fight, put in another rejection candle right there. Still kind of moving sideways for a lot of the same reasons. All of these are paired with the US dollar, so folks are paying attention to inflation, interest rates in the US, central bank actions, and all that kind of thing. But one thing we can see here is we can see a number of key levels at that 549 level, at the 580 level, even back up here around that around 62 level right there has been pretty key, and you'll see some consolidation right around that level. So that gives us a pretty good overall look at things. Things have been trending lower. We do have lower highs, but we have some key levels down here. So if anything, I'd probably want to look at this one. You know, if the dollar starts to decline, then more than likely folks would be buying Kiwis and selling dollars, which might reverse this particular scenario. Hard to say right now. We're still a ways away from, you know, the latter half of this year, and we'll need to see some more price action, some more candle structures to actually determine that. So right now we're getting a flat level setting up. Looks like it might have the ability to break lower. And you can see that right there. Two touches hanging around at that level, a little overextension from the moving average zone. If we go down to the 8-hour, we'll probably see all the moving averages in alignment, fanning down, probably same with the 4-hour. Everything in alignment, 50, 20, 10. The sell candles, the small sell candles in the sell zone, they're not quite in the middle, and so more than likely means we're just too high on the time frames. Go down to the next one, and we'll probably see everything in alignment, including the 200, and we've got those rally and those setup candles, bearish candles, right in the middle of that zone. Nice small one right there, a little bit of a larger one right there, but continuing to sell off to new lower lows. Now we have a rally back into the zone. Small rejection candle, small indecisive candle, probably see those in the middle of the 1-hour chart, like right here, and the break of those candles would be right about there. Stop goes right above the high. But as you can see, if you look closely, we've got a cross of the 10 and the 20 period. So that's no good, and we'd have to go back to the 2-hour chart and look at the setup on the 2-hour chart, which would be very similar. Entry right there, stop above the high of those candles, and looking to get the trade to break even, probably right about here or so, right about there, just ahead of the lower low. And so that's kind of what the dollar's looking like. Don't expect this to really drop to the downside in a big way. We do have there is a key level right there So more than likely, it looks like if it breaks that level, it looks like it more than likely will make a move down to that 58 level. But the good thing about the flat level breakout is that you only trade the breakout if price breaks out from that flat level and then continues to the downside. That's the only time you get taken into that trade. But that's what that looks like. I think there are better trades to find in the price action other than that one. But just kind of a general parameter there on where things might be headed. Let me see some questions here. Another question, I'm a client. I have not found a way to access an archive of webinars for replay. Yeah, you should be getting those via email, usually 24 hours after the session end. You should have an email in your inbox. If you're not seeing it there, check your spam folder. Sometimes it goes there and that'll give you the link to the replay of these webinars. Another question, what are you seeing in the Euro Swiss? Let's check the time right here. We got a few minutes. Let's take a look at the Euro Swiss. That one actually has been trending. It wasn't trending for a long time, but it has been trending. Look at on the weekly chart. I even think on the monthly chart, it's been looking pretty good. And right there, a really nice trend. All four moving averages aligned. Started back in, April of 2018. Prior to that, there was a lot of sideways action in this period there, and then finally started trending. And we've got some good trends going on the Euro Swiss. Lower low, we're starting to get a higher low right there. Actually, that is a lower low, so that doesn't count. Everything is still, let's see, right here, slight divergence right there, not a whole lot, but it looks like we're rallying back up into the sell zone. And keep an eye on that candle. We've got a few more, another week to go on that candle, see if it closes out bearish. If there's a sell-off there and it's bearish, I'd start looking at some of these other charts to see if there's an opportunity for another potential short. Certainly probably not on the weekly, but maybe something lower. And more than likely, we're going to see everything in an uptrend because there is nothing pulling back yet on the monthly chart. So all of these are going to be trending up, but they are diverging, as you can see. Probably the lowest, that one's crossed over, so we can't use the 2 hour. So it'd be everything above the 4 hour and the 8 hour. Those are going to point us longer and higher. And after looking at the monthly chart being around the sell zone, I want to wait to see that candle closes out to see if it's going to close out bearish. And we might be looking at another rollover to the downside. If you want to trade, some of these charts, you have to look at a lot of divergence here. The divergence starts back here with a higher high, higher high, higher highs, and we keep getting divergence and basically a downward trend on the MACD and the RSI, and an upward trend on the euro, on the price action. So not a great trend to trade. More success trading with the momentum and with a lot of price indicator convergence as opposed to divergence. Here we're getting a lot of divergence. So don't tend to like those charts too much, but let's see what the monthly chart has to say going into next week. And then let's see, maybe we've got time for one more right here. We'll take a look at the dollar yen. Dollar yen, again, we're right back up at that key level. We've already made 2 touches, so that is a key level right there at 151.7. Setting up another flat level right here. Doesn't give us a lot of room to run before we hit a brick wall right there. So more than likely, you'll see a pullback after a 3rd touch, maybe put in a higher low, and then a retest, and then maybe a breakout of that level. But for right now, we're setting up a flat level right here. So that might take 3 or 4 touches to break out, and then it might stall right there. If it doesn't reject that completely, usually what happens on these is when you get a breakout above a flat level with 2 touches at an exact level like that, if price breaks out and then it rejects, that's going to be a small price action candle. It's called a plunger. And what that means is when price breaks out and you get divergence on the breakout, see how we have all this divergence right there? Indicators are trending downward, price is pretty much trending upward. That scenario right there, that plunger means look out below. And usually that means once it breaks, that candle closes out. And once price breaks the low of that candle, look out for this level down here at 140. So those kind of candlesticks can be very, very telling when you're at a flat level of 2 touches and price breaks out and then rejects. You definitely want to be out of that trade if you're trying to trade that trend long. And usually before that, you'll have a lot of divergence like this, telling you that this is already a weakening trend, and more than likely you want to move to the sidelines. So that's kind of how that looks. If you go down to some of these charts, you'll see a lot of charts here that are trending really hard. That can easily suck you into a trade if you're not paying attention to your higher time frames. And that's why we use the higher time frames, right? To make sure that we're trading in the direction of the higher time frame trend and not just blindly following a trade setup according to our strategy on a lower time frame when we're trading straight up into a key resistance area where we actually should be taking profit, not actually looking to break that level. So those are some key things around some of these other charts that we didn't have on the previous charts, but that's kind of what things look like. Okay, I think that's just about all the time that we had. I got a few more things to cover with you guys. Let me close this out, and then we'll do something else here and show you a few other things. We'll just minimize that for right now. All right, so at this point, you guys may be thinking, hey, Toby, this is all great, but why should I trade Forex and why should I do it with Forex.com? So a reasonable question, let me kind of walk you through that real quick. As you guys know, Forex trading is a timeless event, regardless of where you live or the time zone you're in. You can trade Forex pretty much around the clock 5 days a week, right? And when you're trading Forex, it's not like you're trading equities, right? Where you're buying an ownership stake in a company. Foreign currency trading is just a speculative paper contract type of trade. It's a momentum trade, if you will, where you're speculating on the short-term direction of specific currency pairs. So as you study the Forex trading strategies that we teach, you'll learn that opportunities exist in Forex, both long and short, and it's just as easy to buy an uptrend or to sell a downtrend. And then lastly, you can trade more with less. Foreign currency leverage is up to 50 to 1, allows you to take much larger positions with less capital, but it's important to understand with that kind of leverage comes additional risk. So you need to manage that risk, got to be aware of it, and we'll show you how to do that with the trade strategies. The risk management is built in. So if you are continuing on from here with one of our advanced strategy courses, make sure you get registered so you'll be receiving the email notifications and the login details for the appropriate sessions. For those of you that still have some questions, they'll stay on a while longer, get those answered for you. For those of you that are leaving the webinar at this point, there's a short survey as you exit. Please take a moment to fill that out. Let us know if you found the content useful. We're always trying to improve and deliver content that's valuable to you. If you guys do have any additional questions, feel free during this time to get those keyed in to the question box on your end. We do have about 10 minutes left. More than happy to answer whatever questions you have. While you're doing that, let me take the rest of the folks over to the Forex website and see what we've got going on here. Let's see, I believe it's under the Learn tab. Foundations of Forex trading. And I believe once we get to this, let's see. Yeah, I believe this is the last month that we are doing the advanced trading strategies. I think this is the month we just ended. So I don't know how Forex is handling that. I haven't received any notification whether you would ask and they would give you a replay of the ones that we've done in the past. But what I would do is get a call into the Forex 800 number and tell them you're interested in the advanced strategy courses that were the trade strategies that we're kind of showing on the foundations of Forex. the Tuesday sessions, and then see what they tell you. So that's, sorry about that. That just ended, I believe, this month. But we're still every Tuesday. I'll still be describing, the various components of the strategies and price action. Every Tuesday we'll be covering that, so you can come back and learn as much as you can from these 1-hour sessions. But it doesn't look like Forex has renewed their contract with us for those advanced sessions, which are basically 4-hour sessions over 2 weeks to cover everything that's included in this trade strategies. But you never know. To tell them you guys are interested, and maybe they'll think about bringing that back, maybe in the future. I think the crowds are getting a little bit thin, and so sometimes you pull stuff back from a marketing perspective, kind of build up a little bit of demand, and then bring them back at a later date, and they tend to get a little bit more bang for the buck. So it's kind of hard on them to spend money for maybe only a couple of people who are attending some of those advanced courses. So it doesn't mean they're gone forever. Just if you guys get your calls in, show an interest, more than likely maybe they'll bring those back in the future. But here's basically where you're going to register for the Forex trading. These sessions today, just from a pure price action scenario, I'll be reviewing everything related to the strategies that we use, and showing you how to look at these charts and giving you some clues about where things might be headed. Okay. So that's that. Any other questions that you folks have for me? Let's see, I think I've got one here. Can you talk about the difference between logarithmic and regular candles? I wish I could. I haven't studied a whole lot about logarithmic. I primarily look at, most of my career, I've been doing this about 40 years. I primarily have always looked just at raw price action with just a few indicators, has always been my technical strategy. And then I've always combined a solid technical strategy with a good fundamental understanding of what it is that I'm doing. So those are really the things that I'm expert in, and at Trade with Precision, we do primarily technical trading based on a momentum strategy, and that's why all the indicators that we use are all leading indicators. So there are all different types of ways to trade. It's just a matter of getting comfortable and learning something. But I think the most important thing for any strategy that you follow is to really understand what the price action is doing. The more you're expert in price action, the more the strategies are going to help you. If you're horrible with price action and you just don't understand it, I don't think there's any trade strategy that's going to work well for you. So there's no shortcut to it. I've been looking at a lot of screen time. I think there's a number on the internet. If you look at mastering anything, a sport, golf, trading, whatever it is, there's a number of like 10,000 hours before you become a master at anything. I've logged a lot more than 10,000 hours. I don't know if I'm a master or I'm not, but I can extract money pretty regularly from the markets, and I do tend to predict price action fairly regularly, and that's usually the test of time in the markets. So a lot of different ways to trade. I don't know all of them, but the ones that we're teaching here I know are very effective. Another question here, perhaps they can promote the classes. I have had an account for some time, but wish I was aware of these classes. Yeah, sorry about that, Dan. Hopefully they'll be bringing them back maybe sometime in the future, but guys, do get a call in there, shoot them an email, let them know that you guys are missing the courses, and see what they say. They just, these haven't had a big turnout, and so they're trying to conserve cash if they don't have a bigger turnout for some of these advanced sessions. Thanks for the compliments, guys. Appreciate that very much. Glad you guys learned something on the live analysis there. Another question. See the person in the corner office who seems to be indifferent. Yeah, I think that's usually the way these things work, right? It's someone who's hanging on to the purse strings. But I think we've done them for a while. I think it was probably a couple of years we've been doing them. And so I think just recently they saw a decline in attendance. And so it might just be kind of a marketing lull of new people grabbing hold of that stuff and coming and attending. So I think that was the primary reason. So doesn't mean that they won't come back. I think maybe they're just taking a little break for now. But thanks again, guys, for the compliments. Very glad you guys learned something. Come back again on Tuesdays. I'll give you as much as I can in the Tuesday sessions and see if we can help you advance your trading a bit. Show you a little bit more about price action. Just kind of dip the toe in today. And so we'll do that every Tuesday, and I'll try to show you as much as I know and see if we can help you. Any other questions before we wrap it up? We got about 3 minutes left. And as you guys know, every Tuesday we're going to have kind of a different topic, but we're going to be doing roughly the same thing, going to the live charts, applying the trade strategies, and then trying to highlight some things in there that you guys may not be aware of. Today it was candlesticks, kind of showing you how those candlesticks set up, the size of the candles, why that's important, how it affects your risk, and all those kinds of things. I don't know what the topic is for next week, but it'll probably be a little something different. And, we'll expose you to another aspect of the strategy over the course of time. Okay. All right, folks, thank you very much for the compliments. Appreciate that. Come back, join us again soon, and look out for that that recording link coming in your email inbox. If you don't see it there, make sure to check your spam folder. You can go over and review all of that price action. I went over that stuff pretty quickly, and so you can kind of study that at your leisure. But have a great rest of the week trading, and we'll look forward to talking to you next time. Take care.